And welcome to the ASIS Economist Board, where we discuss the current economic environment as it relates to industrial production. Each of our models incorporates data from approximately 18 to 20 different economic indices, with our data going back almost 20 years. In this video, where we're going to hit industrial production for manufacturing, and then the 7 related subsector videos that we'll be diving into. We'll talk about what's all the drivers for each of those models and try to relate that to what we're seeing in the real world. So I'm John Nelson. I'm with M&A, and I'm joined today by Keith Prather of Armada. How you doing today, Keith?
Hey, I'm doing great. Sorry, I started to jump in there for a second, but it's all good. Yeah, thanks.
No worries. Okay, so let's go ahead and take a look at industrial production for manufacturing. I'm going to go ahead and I'm going to pull up our first model. And I'm assuming that the screen is sharing.
It is?
Yeah, good. So let me hit the next. Here we go. Here's our chart. At first blush, it looks like we're telling the same story as before, but Keith, as you and I were talking about, there is a subtle difference. It's not so subtle when you kind of take a look at magnitude. Yeah, the trending in the direction looks about the same. You kind of got this bowl effect for the next few months, but what the real difference is the magnitude. And if you look there at the worst point of the drop, as well as the far end point, we're talking about an 8-point positive difference between this month's forecast and what we were forecasting for the next 18 months last month. So what we had talked about, what we were seeing in the models is we couldn't come up with any one particular thing that was changing, but the models were picking up on a number of different factors, things that are pushing and pulling within the larger economic environment.
Yeah, I mean, we know we've got a lot of volatility right now. We were talking off camera. One of the themes that we're using right now economically is that there's a tremendous number of cross currents. So when you think about a ship underway, like on the ocean or lake or whatever, it doesn't matter. That ship will continue that momentum, but as it gets hit with cross currents, it gets pushed left or right, depending on how strong that cross current is, and it has to adjust to come back to center. And so right now, economically, we're kind of in that position where if the U.S. economy were left alone, it would actually be doing pretty well, right? We would be growing at a pretty steady rate. But then all of a sudden, we get these black swan events that kind of hit us, and especially in the manufacturing sector, we suddenly get these cross currents that push us left or right. So the model was kind of reading a little bit of an inventory overbuilding situation, kind of going into the end of the year and spilling over into early next year, kind of coinciding with when a number of forecasts are saying that we're basically going to see, maybe contraction in the economy or recession risk starting somewhere around, Q4 of this year and spilling over into Q2 of next year. And so part of that is just the models grappling with this inventory overbuilding and a little bit of a demand decrease going into the end of the year. But then, just as you and I were talking, we've gotten these cross currents. We've gotten, drying up of the Yangtze River in China, shutting off a lot of southern Chinese production that fed the world. So everyone from Apple and Foxconn to Volkswagen, a whole bunch of automotive manufacturers, literally many multinational companies having operations down in southern China and seeing those supply chains once again disrupted. So the optimism, a little bit of the optimism that we see on the back end of this curve, kind of in the second half of 2023, is a lot of those factors playing themselves out. Supply chain managers trying to reorder products at some point in time early next year, and seeing maybe some of that supply chain congestion pushing their sourcing more domestic. So we see more domestic production, which is what this is obviously measuring. Mm-hmm. And so that's, you've got a lot of factors here that are kind of giving the model that optimism on the back end, as you said, that kind of took the index from, what was roughly a 92, 93 points last month until, up to where it's going to touch maybe 100 by the beginning of 2024. So again, a lot can change, and those cross currents continue to build and continue to hit us. We see the Rhine River closure in Germany creating a tremendous amount of supply chain challenges. You've got, energy issues across Europe. 30% of the revenue from the S&P 500 comes from Europe. And so as that economy gets hit really hard, it has a real headwind effect on the US economy. Makes it tough for us to kind of punch through that and to build economic momentum. And so there's got a lot of those things pulling on us right now. And the models are also kind of wrestling with it.
Yeah, I was one that you mentioned the S&P. One of the things that we talked about is, the S&P looked a little bit more favorable as the data went into this model, and now coming out of it a little bit later, maybe it's not as strong. So it's a lot of mixed measures, and we looked at some inventory numbers that were a little different from one model to the next. So it is going to be interesting. I think the general shape will remain. From the math side of things, I think the general shape will remain the same, but I think you might see this one wiggle a little bit more than we're accustomed to.
Yeah, I think you're right. Agree. Yeah.
Okay, so our next look is this is what it looks like long term. You can see the good news is that towards the back end of the forecast, we get back onto the historical trend. The bad news is it's a pretty big dip here in the short term.
Yeah, and there's so many charts out there now economically. When we look across the kind of the world of metrics that look a lot like this chart, you look at productivity. We just, if you look at the quarter-over-quarter change between Q1 of this year and Q4 of last year, which is the latest we have data for, productivity fell at the fastest rate in history. We also see the unemployment or the employment cost index now at almost all-time highs. So there's lots of pressure building in the marketplace. And so when you see a chart like this and we see that dip and seeing it look a little bit like 2008 in a kind of a normal, if you will, economic cycle, meaning not pandemic, created, it is a little scary to see the dip, and it is a little reminiscent of what we saw in a pretty significant dip back in 2008. The model's not showing that it's going to be as severe, and we don't believe it's going to be as severe, but there's just still a lot of factors out there that could prop it up and create a growth environment above the 20-year trend line like we see here, or that could push it further down and see it dip further. So it's the last thing you want to hear from an economist, that, hey, it could be really good growth or it could be really bad contraction, right?
Right.
We're really good at throwing out, both extremes and, not living in the middle, which is where kind of the real world lives. So
it could go up or go down.
Yeah, right, exactly. It's like the old Saturday Night Live gig, right? Where it was like, the meteorologist said, well, we're going to have, periods of cloudiness followed by periods of not cloudy,
That's right. That's right. Tonight's forecast dark.
Exactly.
We got, this is what our year over the year looks like, it's kind of funny because you got the death cross out there, but what that actually marks is the red dashed line here is the continuation of this line coming off here. So that's why the cross looks like it's going to be there, but you can see this is reflecting in the last couple months down here. So that kind of interpreting the chart, but you can see that we get back up there into ranges that look close to the historical norm.
Yeah. A little bit weaker than maybe we've seen in the last 2 or 3 years, but yeah, not a whole lot more to add to this, other than the fact that there is still just so many different factors in the world that could really change industrial production. Like, we do know that, once again, companies are trying to reshore manufacturing into the United States as fast as they can, at least percentages of their sourcing. And so that is driving a tremendous amount of construction. Construction spending was up almost 20% year over year in July. And we know that momentum continues to build. Raw material availability, the availability of labor, some of those factors have kept some projects on the sidelines. But we do know that there's a lot of manufacturers out that have got to find a way to increase production, and they're concerned about the types of events that are causing current supply chain challenges. So we've moved beyond the pandemic. Even China has kind of moved a little bit beyond the pandemic. The COVID impacts aren't as dramatic and aren't as catastrophic, if you will, if I can borrow that word, to what we see happening with the Yangtze River and the shutdown of hydroelectric power. 80% of the power generated for Sichuan and for Chongqing and some of the areas around Shanghai came from hydroelectric power, and they've got to go flip a switch and revert over to darker burning and heavier burning coal, and until they can get those electricity resources built up again, you're going to see these continuous rolling blackouts, and typically hits the industrial sector first. So
well, you mentioned raw materials, and so we, part of looking at industrial production overall is we take a look at both primary metals and fabricated metals. So I wanted to move on and show you, the primary metal trend looks, it's following that same trend as industrial production. And the difference here is same sort of dip, the end of it looks the same as last month. The difference is the depth of the drop is about 5 points less than what it was before. But you had mentioned raw materials, and here's one of the big ones.
Yeah, and we do look at commodity prices around the world, not just energy, but we also look at raw materials like copper, aluminum, zinc, nickel. And you see inventories of those products around the world dropping, but prices are also dropping at the same time. And it's because of demand destruction. We just don't see the same demand environment. That's also the reason why gasoline prices in the United States are going down, even though petroleum inventories are hitting multi-decade lows. If you look at the strategic petroleum reserves today, it's the lowest that they've been since the 1980s. And then you look at overall petroleum reserves in the United States, and they're still pretty low. They're the lowest that we've seen since probably 2015. And if they continue on this path, they're going to dip below where we were just going into 2008. Remember, in 2008, we hit $147 per barrel price for WTI. So that risk is still there. The difference here is that gasoline prices are plummeting because of demand destruction. We just don't have the same consumption rates of gasoline. And so this primary metals chart is kind of picking up a lot of that action, and it's weighing more heavily on the demand destruction side than it is the supply side.
And looking at it historically, you can see, it does drop way below trend. It's not a good news story, but historically this sector has been falling.
Yeah, and you and I have talked many times about the fact that this is one of the more volatile industries and sectors to monitor and to model.
Yeah.
And even though the accuracy rate on this model is pretty high, the volatility of the model, as you can see, it's so jagged, and it's very difficult to predict kind of where it's headed. So this was, but as you said earlier, when we first got onto primary metals, I mean, this is driven heavily by the other models and by the other industries.
Mm-hmm. Let's go ahead and take a look at over up into fabricated metal. And again, the same sort of trend. The bottom end of the dip is right about where we were last time, maybe up a couple points, but we are improved by about 5 points at the far end, the far end of it. So again, a little bit of a softening. So both this and primary metals telling similar stories and supporting where we're thinking industrial production is going to go.
Yeah, we still see like the automotive sector. If you're a subscriber and you're able to get to some of the other videos that we have behind the paywall, we're showing an automotive sector graph that looks pretty strong right now. And I think in the second half of 2023, the fabricated metal model is kind of picking up some of that strength, because it will lift the fabricated metal sector. So a lot of that's going to be microchip availability and some of those other things that we know have been a problem in the supply chain for automotive and machinery and aerospace and some of those other sectors that really drive this particular sector.
Mm-hmm. Okay, and then just taking a look at this from a longer range perspective, it is a pretty significant dip, because it's worse than what it was in 2008 in this sector.
Yeah, and Chris talks a lot about the fact that a lot of these manufacturers are smaller job shops, and one of the things that's happening worldwide with energy prices where they are, because we still see natural gas prices higher, heating oil, all of those energy products, electricity that go into production of these products, are skyrocketing. At the same time, we're now starting to see a little bit of pressure on the ability to get the price that these companies want for their products. You know, they got higher wage costs. You know, total employment costs are way higher than they were a year ago. There's a thing called the Employment Cost Index, and right now the Employment Cost Index is at all-time highs. So it's interesting, but these companies are getting hit harder than most, and you can see the significant dip in what the demand curve looks like going forward. So I'm nervous. I'm a little bit afraid for many of these small companies.
Okay. Well, that pretty much concludes our look at industrial production at the macro level, and we're going to get on to putting together our sector videos. Hope you can join us for that if you're a subscriber. Keith, any closing comments, or that takes us away?
Yeah, no, I mean, I think we just watched those cross currents again. There are still some evolving black swan events out there, but at the same time, cross currents pushing the other direction. Like we finally see electricity prices in Germany for some reason have dropped by almost 50% in the last 24 hours. So, you know, if you tune in next week, we'd probably have a completely different story going on. But yeah, so much volatility. You know, normal price for electricity in Germany is $45 a kilowatt hour. It surged to $1,000 a kilowatt hour, and right before we jumped on and started videoing, it was down around 400. Wow. So ridiculous, so hard to predict. But that's why we love the models, because the models kind of work through a lot of that, and there's intelligence built into what they're reading. So so anyway, yeah, I hope everyone will join us and jump behind the paywall to get the other videos.
Okay. Talk to you all next month.
All right. Take care.